Previously on Wombat Politics. In part 1, we learned that Medicare is not a flat rate of 2%, and that when people like Penny earn an extra $5,000 from $23,000 to $28,000, they get slugged $500 in Medicare. We also questioned the effect of industry lobbyists on the decision of having a sugar tax. And most importantly, we met the Bartons. Before we start part 2, we have some viewer feedback. Daryl from Udna Data writes, "Dear Wombat Politics, too bloody right. Kind regards, Daryl." Thank you, Daryl. Now, welcome to part 2. As we have learned, Edna earns $80,000 tax-free from super, which equates to Sophie's gross income of $106,000. We are about to start on super tax policy. I would like to say this will be quick and easy, but it isn't and it won't be. Super tax policy would have been number 3 on the bullshit tax policy list for over a decade up to 2017. Historically, the mismanagement of super tax policy has single-handedly added significant generational debt, and it continues to be a massive burden on younger generations. Younger generations that struggle to comprehend the very real implications and the simple injustice of super tax policy. Unfair not just for younger generations, but for all ordinary retirees. Phew, that was wordy. Perhaps the John Oliver quote from episode 1 was enough. Welcome to super tax policy. Edna earns $80,000 tax-free from super, but there is a clever little wording in super tax law, not assessable income. Clever and hugely consequential. Not assessable takes all your super income and ignores it for tax purposes. So the more super you have, which is a bit like saying the richer you are, the more this helps. For Edna, after earning $80,000 tax-free, the ATO will not count this as income. This not assessable income means they treat Edna's earnings on top of the super as if Edna has earned $0. So Edna receives another $33,000 income from the Barton Family Trust. How much tax does she pay on this $33,000? 0. But you knew that, because I had said the Bartons pay 0 tax. Edna is now earning $113,000 and paying no tax, thanks to not assessable income. Edna's $33,000 income from the family trust is subject to LAMITO, lower and middle income tax offset, $255, LITO, low income tax offset, $700, and SABTO, senior and pensioners tax offset, $2,140. That $3,095 in tax offsets mean that Edna pays 0 tax. So now we have $113,000 tax-free for Edna to struggle with, which is the equivalent of a pre-tax gross wage of $160,000. Thank God the ATO gave Edna $3,095 in tax offsets, almost the same amount that renting pensioners get in rent assistance. Just one of the many reasons that super tax policy is number 7 on the bullshit tax policy list. Let's backtrack a little. What is super tax policy? Wombat Politics defines super tax policy as a set of tax concessions set up to help fund retirement for individuals. Tax concessions paid for by the Australian taxpayer that then should save the Australian taxpayer money later on in the form of aged pension. It is not about wealth creation. Wealth creation should be done through the normal income tax system. It is meant to be about supporting people in retirement in a fiscally responsible but dignified way. To examine super tax policy, we will split income earners into 3 groups. Group 1, minimum wage, currently $39,204 per year. Group 2, average wage, currently $89,123 per year. Group 3, high income earner. We will use the top tax threshold, $180,000 per year. At this point, I wish to reintroduce the Retirement Income Review, commissioned by the federal government and completed in November 2020. I will highlight 2 things now and more later on. 1. They also split income earners into groups on page 14. Please feel free to compare. 2. After a table of contents, terms of reference, panel members forward, acronyms, glossary and income groups definition, the report pretty much starts on page 17 titled Key Observations. And the very first point, the Australian retirement income system is effective, sound, and its costs are broadly sustainable. Thank you, panel. And thank you, Scott Morrison, member for the Rich and Powerful. Sustainable, sound, and effective. Sounds great. On behalf of all the high income earners that are being heavily subsidised by all taxpayers, thank you. And on behalf of all low income earners below $20,000 annual income and many primary caregivers, both of these groups would be way better off without any super tax policy. Who cares? The Retirement Income Review was not written for them. For fun, let's elaborate on these claims. So to compare the income groups, we will use the same parameters for all three groups. All three have worked for 46 years, 1976 to 2021. The super guarantee of 9.5% is applied throughout, even though it was introduced in 1991, because the purpose of this is to compare current settings for the different income groups. We will also apply the current 15% super contributions and super earnings tax. Importantly, as previously mentioned and as per page 202 of the Retirement Income Review, we will use 7.5% super returns minus 1% in fees, so 6.5% annual super returns. Their wage in 2021 is as per above, and then working backwards, we will reduce their wage to the equivalent wage in 1976. This is important because you don't get to earn the same wage for 46 years. Not allowing for this would make the super balances artificially high. We have also assumed that the tax saved is comparative to 2021 throughout the years. This is to focus on current settings, and in reality makes the unfairness demonstrated less, not more. Simplified point is, to make comparison between income groups, we are using current settings based on current policies. To be more accurate would be very complex and make any unfairness demonstrated worse, not better. So, based on current settings specified above, we can calculate someone on minimum wage for 46 years can expect to retire with a super balance of $182,915. What is important to note? $8,608 in income tax saved. That means that the ATO has contributed, via tax concessions, $8,608 to their super balance, which equals 4.7% of their super balance. Tax on super adds up to $32,279, or 17.6%. So they have paid a lot more tax on their super than they have saved. Now, to get close to the actual minimum wage in 1976, we reduced the wage by 4.5% each year. This meant they earned $5,409 in 1976. The actual minimum wage in 1976 was $5,236. So 4.5% is pretty good, and we want to use 4.5% again soon. You will see why. Okay, next is average wage. With 46 years of 9.5% super guarantee, 6.5% super returns, and 15% tax on contributions and earnings, they can expect a super balance of $363,034. Now, the ATO has assisted them to the tune of $74,742, or 20.6% of their super balance. The tax paid on their super is $64,065. Once again, this equates to 17.6% of their super balance, and they are paying $10,000 less tax than the tax they have saved. Now, to get close to the 1976 average wage, we reduced their wage by 5.1%. This gave us $9,503 in 1976. The actual average wage in 1976 was $9,396. So, pretty close. Now, for the high income earner, we will use the average income earner's wage increase of 5.1% per year. Someone earning $180,000 in 2021, assuming 5.1% wage increase every year, would have been earning $19,193 in 1976. Their super balance, with the 9.5% super guarantee, 6.5% returns, is $733,214. The first point that needs to be made, given that this high income earner has reached $733,214 it starts to give us an idea of what it takes to reach Edna's $1.6 million of super. Now, how much has the ATO contributed to the high income earner in tax saved? $258,781. And tax paid total is $129,391. Still the same as everyone else, 17.6%. Therefore, they have saved double the tax than they have paid on super. So, over 46 years, paid for by the Australian taxpayer, the ATO contributes $8,608 to the minimum wage income earner. It then contributes $74,742 to the average income earner. And lastly, it contributes $258,781 to the high income earner. Depending on circumstances, Edna's $1.6 million of super would have received approximately $500,000 in tax concessions. But let's not carry on about the minimum wage earner, not when we can consider Maggie, Sophie and Penny's mum. She has spent most of her working life as a part-time cleaner. As such, we can represent her working life with a 2021 wage of $20,000. For the low-income earners, we used the minimum wage earners' wage increase of 4.5%. So, total super balance after 46 years, $109,782. Tax saved, minus $12,615. So, if Maggie just received the 9.5% and she invested it herself, she would be $12,615 better off. Not bad, considering the ATO is happy to give high-income earners $250,000 and Edna $500,000. It then takes $12,615 off Maggie's super balance. Given she only has $109,782, that hurts. Now, some people who can calculate 46 years of super in their head will be saying, that doesn't look right. She should end up with about $93,315. Correct. Maggie gets LISTO, Low Income Super Tax Offset. It basically reduces the contributions tax from 15% to zero for those earning $37,000 or less. Page 79 of the Retirement Income Review, third paragraph, is about LISTO. Ends up with, in practice, the offset removes a tax penalty by refunding the tax paid on superannuation contributions to ensure lower income earners pay no more tax than they would if receiving contributions as income. The part I like most, low income earners pay no more tax than they would if receiving contributions as income. That is awesome. But unfortunately, it is also rubbish. They are only offsetting the contribution tax, not the earnings tax. In Maggie's case, it only reduces the tax by 1/4. That is why Maggie paid $12,615 in super tax when she should have paid zero. Who else does this hurt? Primary carers. Meet Nigel. Nigel worked for 12 years, earning $80,000 per annum. He then becomes a primary carer in his family and earns $0 for 14 years. During those 14 years, he pays $23,204 in super earnings tax, when, given he was on zero income, he should have paid $0. Offsetting contributions tax only 1/4 helps Maggie and doesn't help primary carers like Nigel at all. Another anti-primary carer policy relates to divorce settlements, where the super balances of both partners are not considered. So, the secondary carer ends up with a much larger balance than the primary carer, and the secondary carer is heading for a far superior retirement. There is no doubt that Maggie and primary carers would agree with Scott Morrison, the Honourable Member for the Rich and Powerful, for summarising at the beginning of this supposed review that the system is effective, sound and sustainable. In fairness, it is all those things. You just have to ask, who for? Okay, let's end part 2 there. In part 3, we will discuss deeming and the asset test, rent assistance, and we will bring up the slightly irksome fact there are 6 people with super balances over $100 million, single-handedly costing Australian taxpayers millions. Thank you, and have a good day from Wombat Politics.